Hi, everyone. Thanks for joining us for our 2026 Digital Asset Outlook. For those unfamiliar, Edge Capital is one of the longest running and largest active managers, both in DeFi and CeFi trading strategies since 2020. We manage about $500 million of assets for some of the largest crypto treasuries, foundations, fund of funds, and institutional investors globally. Today's discussion is about where digital assets are heading in 2026 and how we're positioned across risk, yield, and market structure. On the call today is Vadim Khramov, CIO and founder of Edge Capital, and Roshan Golani, investment analyst at Edge. Just a quick disclaimer, this content is for informational purposes only and does not constitute as financial advice. So Vadim, I'll pass it over to you. The big picture for 2026. How do you frame digital assets heading into this year, and what are the most important structural shifts investors should be paying attention to?
Thank you so much, Boback. Thank you for the intro. So our research view is that the thesis for continued crypto adoption still remains strong. Regulations in the US and Europe that have been passed are very supportive. We also see massive stablecoin growth. Stablecoins just passed $30 billion in circulation, and global transactions just passed $30 trillion, right? So this is a massive scale, massive improvement. We also see lending markets in the DeFi and crypto space are growing. The balance sheet is about $100 billion between smart contracts and the private OTC deals. We also see big narrative of perpetual decentralized exchanges like Hyperliquid that have emerged over the past 2 years, as well as yield-bearing stablecoins like Athena. We've seen a big wave of digital asset treasuries that took place last year, also expanding. So these fundamentals are actually important for the further adoption and tokenization of assets, as well as conversion from a simple token model to more like an equity style model. What we've seen in the second half of last year, we've seen a few narratives. We've seen one narrative is reassessment of the token model, when people say we should look at the companies like actual equities, right? So, and value them as equities. And the second big layer, people start asking themselves, which of these companies are successful, which of the companies are profitable in the digital asset space. So we have exactly the same view. We view these things from the equity perspective, and we view this as businesses. So we're going to deep dive a little bit deeper in a second in a number of questions over here, but we cover them in our report. So I think the core issue that I think people like looking into this, and we think is fundamentally critical, is that what happened on the regulatory side in 2025 is really unprecedented. It never happened in the past 10 years in our sector because we have a Genius Act in the US, which opened a lot of stable coins payments, which is extremely efficient. If you think about it, the core use case for crypto is really payments. Really fast, really cheap, really efficient, fast settlement. Why would we pay the banks to keep our money over the weekend and pay themselves when we can use crypto to do almost instant settlement? The second big layer is clearly additional legislation taking place in the US that would allow yield-bearing stablecoins and tokenization of assets. This is pretty much happening already. So we also see mega regulations in Europe, and we see regulations in the UK that were passed. Clearly, there are some concerns in terms of their somehow restrictive, but at least now we have a clear gameplay or a field when we understand these are the rules, that's what can be done, that's what can be issued, that's how we should trade. So as long as these rules are here, we'll bring more institutional capital coming into the industry. And we actually see it. We see a lot of steps done in the US. We see a lot of European companies and banks moving more to crypto and tokenizing the assets. So structurally, we think it will take a little bit because the regulations we just passed, some of them are getting passed this year. So towards the end of this year and next year, we'll have a big wave of new companies going into the digital space, plus banks and exchanges in TradFi, tokenizing assets and everything else. So Roshan, you did a lot of research on stablecoins and tokenization that we discussed in our overview. Why don't I pass it to you so you could discuss it?
Yeah, thank you for that, Vadim. And as you said it, stablecoins are no longer a crypto niche. Stablecoins have, in our view, become the most established and economically relevant application in digital assets. They're becoming deeply embedded in core payment infrastructure. To set the scale, in 2025, total stablecoin supply crossed $300 billion, and stablecoin transaction volumes have scaled rapidly and now operate at the multi-trillion-dollar annualized levels. On a relative basis, they sit within the same order of magnitude as large payment networks and materially exceed traditional remittance and digital payment rails. We believe that efficiency is driving this structural shift. Stablecoins bypass correspondent banking entirely. This moves settlement time from days to seconds and costs from dollars to cents, together enabling real-time global payments. Regulation in 2025 has been a key inflection point. The Genius Act clearly defines payment stablecoins as fully reserved instruments, backed one-to-one by cash and short-dated treasuries. They sit outside of securities law, which removes a major institutional barrier. Another key shift for 2025 is that yield is no longer a differentiator. Issuers cannot pass reserve yield directly to users, and so competition has moved towards distribution, integration, and product design itself. The big picture here for stablecoins is that they're becoming a transactional money. They're embedded directly into payment and treasury workflows, and they're becoming increasingly entrenched as a pillar of modern financial infrastructure. And then, as we move to tokenization, in my view, institutions are engaging with tokenization now because it has moved beyond experimentation and into practical balance sheet use cases. The focus is no longer on access or market expansion, but on operational efficiency. Over the past year, the value of tokenized real-world assets, excluding stablecoins, went from $5 billion to roughly $18 billion today. This marks a 260% growth year over year, and we expect it to continue on this trajectory. The growth that we're seeing here has been driven primarily by institutional activity rather than crypto market cycles. More specifically, most of the deployment today is concentrated in tokenized US Treasuries, not because of yield, but because treasuries already sit at the center of institutional liquidity and collateral management. In this context, tokenization acts as a settlement and collateral upgrade. Settlement compresses from T+1 to minutes, and collateral can be mobilized and reused intraday, enabling tighter margining and more efficient capital utilization across venues. Other asset classes are developing more gradually. Private credit and fund structures are expanding, but remain constrained by bespoke underwriting and transparency limitations, and tokenized equity products are now being regulated and introduced, signaling a growing institutional comfort with on-chain distribution, although structural and regulatory frictions continue to limit the near-term scale. The broader takeaway for tokenization is that institutions are engaging with tokenization now because it delivers tangible balance sheet benefits. Real adoption is showing up in areas where tokenization improves treasury management, collateral mobility, and liquidity efficiency, positioning it as a capital efficiency layer rather than a parallel financial system. I think that's all on tokenization. Now, perhaps back to Vadim to speak a bit about the lending markets, perp dexes, and structural basis in the crypto markets.
Thanks, Roshan. I think the way we see it is like what you mentioned. Tokenization is a big thing in our industry, including payments and everything else. It's just simplification of things. What I think we already have seen in crypto, we've seen now, number one, lending markets are booming. So what does it mean? There is natural demand to borrow against Bitcoin, and it's been extremely efficient to do it using DeFi smart contracts. If you take other, more full Maple Finance and a few others, we just passed $100 billion in balance sheet activity, and I would say trillions of dollars of lending that took place in the past 5 years. This is all fully automated, spreads are very, very low, extremely efficient, global. It reduces barriers, reduces brokerage fees and costs. So the lending markets are really a unique example of how these businesses can be really scaled. And all these companies are very profitable. If you think about it, if lending protocols are charging a spread between borrow and deposit rates across millions of users, right? They do have capacity to generate yield. So that has been the narrative of the past 2 years, and clearly this market has been very active. And we also see big players in the industry, institutional players, using them more and more active. The second big block has been DeFi basis trading. So what is basis trading? Basis trading is really cash and carry trading, right? In TradFi, this cash and carry is extremely efficient because you have cross-prime brokerage across multiple exchanges. In crypto, you have multiple tokens, multiple venues. You have different cost of leverage, much more volatility. For that reason, basis trading can be effectively wrapped into form of stablecoin. So Athena is one of the examples that grew up to more than $10 billion in assets. Is effectively cash and carry synonym of what we think in traditional finance. Except the difference is that it's been making from 5 to 30% a year, right? So, and this type of trades, A, has been wrapped into stablecoin, B, distributed globally, C, done in an extremely efficient way with instant settlement 24/7, right? So most of the people don't have access to this, but that has been the narrative that we think is extremely important for the whole industry. I think the next big layer in terms of development of our industry has been development of perpetual DEXs. So the biggest one that took place and has been actively growing is Hyperliquid. Now we have a couple of others, including Aster and Lighter. So Hyperliquid has developed an extremely efficient settlement system where you can trade perpetual futures as well as spot, fully decentralized, and the volumes are massively growing. The company is currently traded at $25 billion valuation approximately, right? And Hyperliquid became the most profitable company on the planet of revenue per employee. So I think the narrative of this is very important. It tells you the following. It tells you that companies in crypto can be extremely scalable, B, can be extremely profitable. It does not exist in traditional finance, right? It takes a while for these companies to come to the market, and then it takes them a lot of time to build it, right? So in crypto, instead, within a year or two, the best of the best can really take over the market and scale it globally really, really fast. You don't need to receive 50 licenses in multiple jurisdictions. You don't need to wait 9 months to pass KYC or get licenses in the US and in Europe. These things are really decentralized. That's why they became efficient, profitable, and really successful. Let me pause over here. I think please read our report. Reach out to us if you guys have any questions. Thank you so much, everyone, for joining.